Most entrepreneurs think because they have bad credit or no collateral, there is no chance to get a loan. But in reality, there are many different financing options for business owners. They can qualify, even with severe credit challenges, or even with no collateral. As you already know, banks demand good credit and collateral to get approval for business financing. Yet most people go to their bank when they need money because it's the only place they know about. But the most common business bank loans, from the SBA, only account for 1.1% of all business loans, Department of Revenue 2013. Big banks do not supply most business loans. And even though they demand good credit and collateral to qualify, many sources do not. The big banks are very conservative, as most know. Due to this, they often do not lend if the business owner has challenged credit or the businesses has no collateral. But businesses can succeed even if the owner does not have perfect credit or assets to pledge as collateral. Many business loans make good sense and have risk low enough due to other factors. So what types of funding can you get with credit issues or if you lack collateral? Before you know where to go to get money if you have credit problems, you first should know where not to go. These sources might be appealing due to their offers and promotions. But they rarely lend money if you have challenged personal credit. SBA loans and conventional bank financing are out. Private investor money and unsecured financing can also be problematic. They all have stringent credit requirements. Where not to get financing with bad credit or no collateral. SBA and other bank conventional loans are tough to qualify for. This is because the lender and SBA check all aspects of the business and its owner. For approval, all aspects of the business and business owner's personal finances must be near perfect. There is no question, SBA loans are tough to qualify for. This is why, according to the Small Business Lending Index, over 89% of business applications get denials from the big banks. Many people think when they have bad credit or lack collateral, a private investor is the best answer. But investors often want average or better credit of 650 scores or higher. And they almost always want you to pledge some type of collateral. They also want solid financials for at least 2 years. This means tax returns showing large net profits increasing over time. Think of private money as being for SBA and conventional bank loans just missing the mark. Unsecured means collateral is not necessary for approval. A lack of collateral increases a lender's risk. No collateral often means the quality of credit determines qualification. Any type of financing not asking for collateral or cash flow will demand good credit to qualify. Where to go to get financing with challenged credit or no collateral. Revenue-based financing, asset-based financing, equity financing, crowdfunding, business credit, and unsecured financing using a credit partner or personal guarantor are all great funding options. They can work for any entrepreneur with personal credit issues or lacking collateral. There is a lot of capital which business owners can get. This is so even with personal credit issues or no collateral. Most of it is not available through big banks. And the great news is you can qualify on the basis of your business strengths. This is as long as your business has even one strength. The big banks want your entire business and you to be near perfect to get money. But as you're about to discover, there are a lot of other sources which will loan money, even lots of money, on the basis of just on one strength. So as long as you have a strength to offset a weakness of bad credit or lacking collateral, you can get approval. Creditors call these compensating factors. Cash flow-based financing. Many businesses have already proven concept and have consistently increasing sales. Their strength is they have shown stability and the entrepreneur can effectively run a growing business. The risk to the lender is less as they are established, growing businesses. How are your sales? Sales are the difference between an untested concept or idea and a real operating business. Will your idea be well received? Do you know how to operate a business? Sales can answer these questions. If you have consistent sales, the next question is, does the business have existing cash flow? You can prove this with bank statements. There are lending options where you only need a quick bank statement review for approval. They do not even need to look at your tax returns. So even if your business shows a loss, you are still okay. The next question, does the business have over $60,000 in annual credit card sales? Does the business have over $120,000 going through their bank account every year? If the answer is yes, then revenue financing or merchant advances might be the perfect funding product. For this type of cash flow-based financing, you must be in business 6 months. No startup businesses can qualify. You should have at least 10 deposits per month or more going through your bank account. It cannot just be a few larger deposits. Most advertising for bad credit business financing are these products. These are advances of 6 to 18 months. They are mostly short-term at first, such as 3 to 6 month terms. Then when you pay half down, the lender will lend more money at a longer term, such as 12 to 18 months. Loan amounts often go up to $500,000. Your actual loan amount has a basis in your revenue. Often, you can get a loan of 8 to 12% of annual revenue, on the basis of your verifiable revenue per your bank statements. For example, a company with $300,000 in sales might get a $30,000 advance to start. 500 credit scores are acceptable and downright common with revenue and merchant financing. Bad credit is okay, as long as you are not actively in trouble, e.g., in a bankruptcy, or you have serious recent and unresolved tax liens or judgments. For this type of cash flow-based financing, 10 to 45% rates are common depending on risk. Risk factors include industry, time in business, and credit quality. Bank statement details are also important. They include the number of deposits, average daily balance, NSF charges, and the amount of deposits per month. Often rates are higher on first advance until you prove yourself to the lender. You need not provide tax returns or other income documentation. And you need not provide collateral. Collateral-based financing. Collateral-based financing is also known as asset-based lending. Here, you get money on the basis of the strength of your collateral. Since collateral offsets the lender's risk, you can get approval with bad credit and still get excellent terms. Common business collateral might include account receivables, inventory, and equipment. You can secure up to 80% of receivables within 24 hours of approval. You must be in business for at least 1 year and the receivables must be from another business. Rates are often 1.25 to 5%. Or use inventory as collateral for financing and secure inventory financing. The smallest inventory loan amount is $150,000 and the general loan-to-value cost is 50%. Thus, inventory value must be $300,000 to qualify. Rates are often 2% per month on the outstanding loan balance. One example where this can work is a factory or a retail store. With equipment financing, lenders will undervalue equipment by up to 50% and work with major equipment only. A lender will not combine a bunch of small equipment. First and last month's payments are necessary to close. Loan amounts are available, often up to $2 million. Common personal collateral that can qualify for collateral-based lending might include a 401k and stocks. If you use a 401k or IRAs to get up to 100% financing, rates are often less than 3%. This type of investment creates a retirement plan, allowing for investment into the corporation. Funds roll over into the new plan. The new plan purchases stock in the corporation and holds it. The corporation is then debt-free and cash-rich. With securities-based lines of credit, get an advance for up to 70 to 90% of the value of your stocks and bonds. These work much the same as 401k financing with similar terms and qualifications. Equity financing and crowdfunding. With equity financing, you trade a part of the ownership in your business for financing. This is much like on the TV show Shark Tank. Personal credit is not an issue. You need not provide collateral. But equity investors are looking for a tested and proven concept. So sales help with approval. You might find some investors willing to invest in a concept only, or an invention. But most want to see an operating business earning money and making profits. And expect them to demand a large piece of business equity. For it to be worth their time to invest, they might want 10 to 60% ownership of your business. That means they take a large part of future earnings. You may want to consider this before recruiting an investor. There are many websites to get crowdfunding for your business. This type of funding gathers money from a crowd. That is, a lot of people rather than one big investor. If the crowd likes your idea, they may donate money to your project. Much of crowdfunding need not be paid back. Many investors are people you know. But if you investigate crowdfunding, you find all types available. Some types of crowdfunding sources want a certain percentage of return. Some want a % of equity ownership. There are different sources and platforms for different needs, and even unique niches or industries. So make sure you find the right crowdfunding platform for you before you post a project. Business credit and unsecured credit. Business credit is a great way to get money, as approvals have no basis in personal credit. No collateral is necessary for approval. Business credit reports often kick off with a few vendor accounts. Initial accounts create trade lines that establish a credit profile and score. The company's new profile and score lead to getting credit. New credit comes from the company's credit per the EIN, not the owner's credit from their SSN. Personal credit does not matter as the credit links to the EIN used for approval. When you use vendors to build your initial credit, you can then leave your SSN off the application. You can apply for business credit based solely on your EIN at most retail stores. Plus, you can get cash credit, like high-limit cards with MasterCard and Visa. But building business credit all starts with vendor accounts. Without them, you cannot start your credit profile. Establishing that profile is the key to getting cash and retail credit cards for your business. Once you find vendors to apply and use your credit. It takes about 1 to 3 months for those accounts to report to the business bureaus. Once those accounts are on the report, a business credit profile and score exist. Use it to get retail credit cards next. Once you have about 10 payment experiences reporting, you can then start to get cash credit like Visa and MasterCard accounts. A payment experience is the reporting of an account to one business bureau. So if an account reports to 2 bureaus, it counts as 2 payment experiences. Get approval for vendor accounts right away that offer credit on net 30 terms. Once you use those accounts, they are reported. This takes about 30 to 90 days. Then, in 90 days or less, use your newly established credit to start to get high-limit retail credit cards. Then in about 30 to 90 more days, get approval for $5,000 $10,000 limit cash credit cards to use almost anywhere. Due to this fast building and approval time, business credit makes a lot of sense for credit-challenged entrepreneurs. Unsecured credit does not demand collateral. But it does demand good credit. If you have credit issues, you can still get approval if you have a good credit partner or someone with good credit to sign as a guarantor. The guarantor is then liable for the business debt in case of default. Approval amounts range from $10,000 to $150,000. Card limits are equal to what the signer has on their credit now. These accounts report to the business bureaus in most cases. So they also help build your business credit and do not show up on the guarantor's personal credit report. Your guarantor must have excellent personal credit to qualify. Summary. Lucky for us entrepreneurs, there are many different viable financing options. This is even if you have challenged personal credit or lack collateral. The key is to know where not to look, and not waste your time. And is it key to know where to look, the places that will approve you because of your strengths. If you have personal or business collateral, you might qualify for financing right now. If you have cash flow of more than $10,000 per month, you might qualify for cash flow-based financing right now. If you have a partner or other party to sign as a guarantor, unsecured financing is yet another good funding option. And even if you have no collateral, no cash flow, no guarantor, and bad credit, business credit is still an easy and fast way to get your hands on money to build and run your business. We hope this helps you get one step closer to getting money to build the company of your dreams. We offer all these financing options and more, so if we can be of help, please let us know through getyourselfcreditnow@gmail.com or 775-690-3839.